And it's time for Business Now with Kate Moody. Hi, Kate.
Hi, Monty.
So, fears of the Omicron variant having causing some trouble for global markets.
Yeah, we saw a pretty stark sell-off on Friday as concern over that new strain of COVID-19 emerged. Things stabilized somewhat on Monday, but global stocks are back in the red today. It's partly in response to a warning from the head of pharma giant Moderna that he didn't expect current vaccines to be very effective against the new variant. We're seeing losses of around 1.5% across the board on Wall Street. The Dow Jones has shed over 500 points this hour. The S&P 500 down 1.6% this hour. Earlier, the major European indices closed firmly in the red too. The Frankfurt DAX down over 1 percentage point there, 0.7 and 0.8% respectively in London and Paris. Let's turn now to Christian Lawrence, Chief Market Strategist at Rabobank, New York. Thanks for being with us this evening. We saw markets attempting a bit of a rebound on Monday, but today we're seeing a return to this volatility. How much of that do you think is linked to this new COVID variant?
Well, certainly on Monday, we did see a bit of a buy the dip mentality, mainly from US retail traders, which are quite a large part of daily flows nowadays. But today, the real issue were comments from Powell, from the Fed, who essentially suggested that the Fed might end tapering of QE earlier than previously expected, which I think a lot of people in the market are essentially expecting means that the Fed is opening the door for rate hikes in the middle of next year. So I think that was the primary driver of the risk-off move that we've seen. But of course, markets very worried, very jittery about the Omicron variant, and we just don't know enough about it yet.
Let's talk a bit more about that statement then from the U.S. Federal Reserve Chief Jerome Powell. He warned of the new risks of this new variant, but he also, as you say, opened the door to potentially faster tightening of monetary policy in the U.S.
Indeed. Well, I think in the US at the moment, there is a consensus that essentially, yes, the Omicron variant might be more contagious, but the early signs suggest that it's not as dangerous. Now, I must be clear, it is early days. We don't know this for sure at the moment. But I think the US markets are generally taking the attitude that the Delta variant didn't result in large, widespread lockdowns across the US, and the Omicron variant is unlikely to as well. So while it is a risk in the wings, it's not one that I think the market is fully pricing in yet, because we do need to wait a few more weeks to get the data to have a real idea of what this variant is like. But the fact that Powell almost sort of pushed that aside and did view it more as a tail risk and went ahead with a far more hawkish stance than we've heard from him recently was a bit of a game changer. The 2-year Treasury yield in the US jumped 10 basis points in a matter of minutes, which is a huge move for such a short time period. And we did see the dollar jump very dramatically as well. So euro dollar fell quite sharply in a matter of minutes again. So big moves today. But this idea that we're going to see more volatility, big moves in financial markets, they're here to stay, and we're going to see them for the weeks and months to come.
Now, inflation is another real major issue for investors and consumers around the world, but central banks, at least in the US and EU, haven't really addressed it, showing signs of a change from Jerome Powell there today. Do you expect it to change for the Fed and perhaps from the European Central Bank in the coming weeks?
Well, you're quite right with the Fed. Jerome Powell removed the term transitory. He said we should no longer be calling inflation transitory. But I think one of the difficulties central banks have had up to this point is that a lot of the inflationary pressures we're seeing at the moment are really as a result of supply chains. And that's not the type of inflation that central banks have the tools to fight. Quite frankly, the Fed raising rates doesn't help you get a ship from China to the US any quicker. And that's the real issue that we're seeing at the moment. In fact, one could argue that higher energy prices, as we're seeing, higher food prices, as we're seeing, might hurt households further down the line and lead to growth slowing. So it's a very complex situation for central banks to deal with. And in the US in particular, there's been the complication of labor market distortions. Very large government handouts earlier in the year have really shored up the health of household balance sheets. So we haven't seen the same return to the workforce that we would have normally expected by now. So there's still a lot of question marks out there, a lot of uncertainty, and that's why the markets are likely to remain very volatile indeed.
And of course, this reminder for investors and, of course, the rest of us that the pandemic is far from over. Christian Lawrence from Rabobank, thank you so much for joining us on France 24 this evening. Well, the UK's antitrust watchdog has told Facebook that it must sell the platform Giphy. The social network, whose parent company recently rebranded itself as Meta, bought Giphy last year for a reported $400 million. But the Competition and Markets Authority said the acquisition would see Facebook, quote, increase its already significant market power by potentially denying or limiting other platforms access to Giphy and its collection of animated images. Meta may decide to appeal the ruling. In the U.S., the price of coal has hit record highs in recent weeks. Power plants in the U.S. and elsewhere are burning more coal because of a global shortage of natural gas. But American stockpiles have dwindled to their lowest levels since the 1970s, with demand set to rise this winter. Coal remains an important source of power generation in the U.S., although about a third of its capacity has been closed since 2010 in an effort to switch to less polluting energy sources. In India, coal is also a hugely important part of the energy industry. Mines in the northeast highlight the challenges the country faces as it seeks to reduce pollution and reach net zero carbon emissions by 2070. Nick Rushworth reports.
There are more than a dozen mines and coal-fired power stations at Singrauli in northern India. Soot and sludge line the roads as lorries, trains and ropeway cars carry huge mounds of coal. Residents have little choice but to breathe in the air.
Even the cows look like buffaloes here. We have to talk about how we are going to stop this. But closing down the coal mines is not the solution. The way to solve this problem is to use new technologies to cut down on pollution.
As Asia's third biggest economy grows, its hunger for coal is mounting. Consumption has doubled over the last decade. The fuel powers 70% of the country's electricity grid. Amid huge international pressure, New Delhi has said it will be carbon neutral by 2070. That, though, is a decade after China and 20 years after the world's other big emitters.
India said at the Glasgow Climate Conference that rich countries have to provide trillions of dollars to help developing countries make that transition, because developing countries are not responsible for the climate crisis we face today. It is the historical emissions of the rich world that have caused the crisis.
Northern Coalfields, the state-run mining firm that owns over 80% of the coal at Singrauli, says it is trying to make its operations less polluting. But activists say such piecemeal measures serve no real purpose. For the people who work there, around 30,000 of them, the fear is that they will have no future without coal.
Monty, that's all the business news for now.
Okay, thanks a lot, Kate. And that's it for now. Stay tuned for more world news coming up here on France 24.